G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, I'm going to be giving you guys my updated Tattooed Chef valuation. So about a week ago, I posted a video on my previous Tattooed Chef valuation, and I received some comments regarding how I didn't consider share dilution and different revenue growth scenarios, as well as different margin expansion scenarios in my valuation. So today guys, I'm going to be providing you with those additions in my valuation to give you guys a better idea on what we should be paying for Tattooed Chef shares, depending on what sort of expectations you have regarding their dilution, regarding their revenue growth, and regarding their margin expansion. And I think those three areas are going to be the key drivers of returns for Tattooed Chef. So obviously we want to see high branded revenue growth, we want to see margin expansion over time, and we want to see minimal share dilution. So currently Tattooed Chef is a cash burning company. They are losing money essentially every quarter. However, as their margins increase, which I do believe they will increase over time due to a variety of factors, one of those factors is that I do think shipping costs will decrease. So companies such as Tattooed Chef who ship their products will get pretty much lower their expense there. They also recently signed a new cold storage agreement, which halves their cold storage cost, which was another significant cost that Tattooed Chef was facing. They're also shifting to higher margin products, such as ambient products and refrigerated products. These have higher margins than their frozen food. So if those are successful, they should increase margins in that aspect. Another reason why they should expand their margins over time is they've got two newly acquired facilities. One is in their Belmont facility in Ohio. The other one is their Foods of New Mexico facility. Currently, they're producing a lot of private label products out of those facilities, which has actually dragged down their margins temporarily. And once they ramp these products and start selling branded products out of them, this should reverse, and because their branded products are higher margin, so that should also expand margins. And then finally, they're also spending capex into automating their facilities, and pretty much what this is going to do is it's going to increase the efficiency of their facilities, it's going to decrease labor costs, and it's going to increase production. Thus, that should expand margins. But let's move on to the first case here. So currently the share price is $6.30 and we've got a market cap of $520 million. So we're going to assume in our first case minimal dilution, low revenue growth, and low margin expansion. So we're going to give a revenue growth rate here of 20%. So how did I get 20%? Well, Tattooed Chef management team, they came out and said by 2025, we're aiming to hit $600 million in revenue. And to get to that $600 million in revenue from their current revenue, that implies a annual growth rate of 28.6%. As a result, I'm going to use something more conservative and I'm going to say 20% revenue growth going out to 2025. So if we take their 22 estimate revenue and grow it out by our 20% revenue per year, that gets us a revenue of $488 million. And if we apply a net margin of 4%, so this is conservative, I'm going to jump over to my other spreadsheet here. There we go. And we can see other food brands and what their net margin is. And you can see Tyson Foods at 6.5%, JBS 7%, General Mills almost 13%, Conagra Foods 11.5%. And we get an average net margin here of 9.5%. But if we go back to our spreadsheet, I've selected 4% here, which is well below the average. It's more than half. It's less than half of the average. So if we then take the revenue and multiply it by our net margin, we get a net income of $19.5 million. And if we apply a PE ratio of 20 and then assume annual dilution rate of 2%, well, how did I get 2%? It's pretty simple. I went on the cash flow statement and I looked at the line stock-based compensation. This is what creates share dilution. And you can see in the fourth quarter of 2020, they did have a fair bit of stock-based compensation, 15 million. And then in the following quarter, a bit over 3 million there. And these are one-off expenses here. This was due to the merger. So these are expenses related to the merger, so we don't have to, necessarily worry about these repeating. And if we take the last 4 quarters, this adds up to be just over 3 million. And if you go 3 million divided by 520 million, that's well less than 1% dilution. And I don't think that the share-based compensation will come back to these levels. I think it will grow from these 1.29 million levels over time. So I've been conservative and I have put 2% for share dilution. And then as a result, that gets us a 2025 estimated share price of $4.43, indicating an annual return of negative 10% for this scenario. So if we move on to case 2, this is significant dilution, low revenue growth, and low margin expansion. So it's pretty much the same as my previous valuation, except I account for a $100 million capital raise at the current share price. So essentially, this is going to increase our shares outstanding in 2025 from 88 million to 105 million. As a result, this decreases our estimated share price, which we're looking at $3.72, or a negative annual return of 14%. So I just want to touch on this capital raise. So the company have came out and they said they're going to be EBITDA positive by the end of 2023. So the company has about $50 million remaining on the balance sheet. And yes, they are burning cash every quarter at the moment. However, as we approach 2023, so I'm kind of 50-50 whether they're going to have to dilute. So if they can reach profitability by the end of 2023, I think the chance of them having to do significant dilution is fairly low, as those losses approaching the end of 2023 should also narrow at the same time. So we're probably not going to be losing 20 million a quarter. It's probably going to be more so, maybe 10, 15 million for the next sort of quarter or two. And then it should drop down as we approach closer to profitability. But I do admit it seems quite tight, and yeah, share dilution is a real possibility, especially if the company wants to expand more. So third case is minimal dilution, base revenue growth, and base margin expansion. So we're going to use the company's long-term guidance, which is a growth rate of 28.6%. We're going to bump the margins up a little bit to 7%. So this is still below the average that we saw from the table before, because I think Tattooed Chef's going to take a little bit longer than 2025 to reach the margins of some of the more established food companies. However, we will be assuming 7% here. That gets us a 2025 estimated net income of 42 million. If we slap on a PE ratio of 25, which I do want to explain to you, it seems pretty low considering the other brands in the industry have an average PE of about 17, and these companies on average grow 3%. So if Tattooed Chef's growing 28% per year, and we're looking at, a PE of 25, that feels quite low for a food company, quite honestly. However, for the sake of being conservative, we're going to continue with our 25 PE here. Annual share dilution rate of 2%. In this case, we're looking at a 2025 estimated share price of $11.93, and this gives us a CAGR of 20%. Our fourth case is significant dilution. Base revenue growth and base margin expansion is essentially the same as the other valuation, except that we're going to be assuming a $100 million capital raise at the current share price. And this gives us a 2025 estimated share price of $10 and a annual compounded growth rate of 14%. And then if we go into our more bullish case, which is minimal dilution, high revenue growth, and high margin expansion, we're assuming that they beat their own guidance here and they deliver 32% revenue growth, which would be a $50 million beat on their long-term guidance. We're going to assume a net margin of 9%, which is the average of those other food companies. We're going to assume a PE ratio of 30, which could be on the low side if the company does perform to these standards. Annual share dilution rate of 2%, and that gives us a 2025 share price of $19.90, or a CAGR of 39%. And, this would take us back to where the share price was about a year ago for Tattooed Chef, which is pretty crazy how far it's come down. And then case 6, this is assuming dilution, significant dilution, high revenue growth, and high margin expansion. So we're adding in that $100 million capital raise. This gives us a 2025 estimated share price of $16.69, or an annual return of 32%. Now, I've given you 6 different cases here, but obviously there are more than 6 different cases, because if you do the math, you could have, medium revenue growth with high margin expansion, or you could have medium revenue growth with low margin expansion. So guys, I encourage you to create your own model and play with your own numbers and input what you think is realistic. Maybe you think none of these cases are realistic. Maybe you think some of them are, but some of them aren't. I certainly think some of them are realistic and some of them are not realistic. Like this case 5, it seems quite optimistic. This is assuming everything goes perfectly to plan. But let's play around with it just for fun. So let's drop this down to our guidance revenue growth here. And look, let's put in 5% margins. We haven't had anything with 5% margins yet. So in that case, look, we're assuming no dilution here. We get 15% per year. Maybe you think they're going to do 6%. You're looking at 21% per year. Let's say you don't think they're going to get their margins expanded. You think they're going to have 0% net margins. Well, look, you're going to get minus 100%, because in this valuation, we're valuing the company based off earnings. So if it never makes earnings, then it's worth nothing, right? Well, in reality, it's not, because someone's gonna not. This business is obviously worth more than 0. But guys, this is just to show you all the different scenarios. Maybe you think revenue growth rate might be higher. Maybe you think it might be lower. Maybe you think net margins might be higher, might be lower. Maybe you might think that there's going to be more share dilution or less share dilution. It's really up to you to decide and do your own research. I've just presented different cases for you guys to give you guys an understanding or a bit of an idea on what you could possibly expect. But it's really up to you to know, and it's based off your research to know, what is the most likely outcome for Tattooed Chef. But guys, hope you enjoyed the video. I hope it cleared up some things regarding some of the things that I missed out on my last valuation. Make sure you like and subscribe, and see you in the next one.